Two machines ran at the same time on Friday, one in New York, one in Shenzhen, China. Together, they manufactured silver's lowest price in months, and almost nobody is talking about both of them at the same time. Mark here from GoFinance. What I'm about to show you in the next 13 minutes is the mechanical truth behind Friday's crash. Not the headlines, not the Kevin Warsh narrative, the actual engine room, the nuts and bolts of how silver went from $120 to $71 in less than 20 hours. Because here's what most people missed. The crash didn't happen because the world decided silver was worthless. It didn't happen because fundamentals broke. It happened because two separate leverage systems, one American, one Chinese, blew up at the exact same time. And when leverage systems blow up, they don't just lose money, they force sell, mechanically, automatically, billions of dollars worth. Let's start with the first machine, AGQ, ProShares Ultra Silver, the most popular leveraged silver ETF in the world. If you've traded silver in the last year, you know this ticker. AGQ gives you 2 times the daily return of silver. If silver goes up 5%, AGQ goes up 10. If silver goes down 5%, AGQ goes down 10. That sounds simple. But here's the critical detail that changes everything. AGQ has to rebalance every single day to maintain that 2 times leverage. Every day, without exception. It's not optional. It's built into the structure of the fund. What does rebalancing mean? It means after every trading day, AGQ has to adjust its silver futures positions to match the new value of its holdings. If silver went up, AGQ adds more silver exposure. If silver went down, AGQ has to sell silver exposure, automatically, to keep the leverage ratio exactly at 2 times. On a normal day, this rebalancing is tiny, a few $1 million. Nobody notices. Markets absorb it easily. Friday was not a normal day. Going into Friday, AGQ held approximately $5.2 billion in assets. That meant AGQ had over $10 billion in silver exposure, because 2 times 5.2 is $10.4 billion. Then silver started falling, hard, fast. The Kevin Warsh nomination hit. Margin calls started firing across the board. Silver dropped from around $110 toward $90, then $80, then lower. And here's where the machine kicks in. As silver fell intraday, AGQ's assets shrank. Not because investors were selling AGQ shares. Only $7 million actually left the fund on Friday. $7 million out of $5 billion. That's a rounding error. The assets shrank because the value of AGQ's silver positions collapsed. Silver down 36% intraday, AGQ down roughly 60%. $5.2 billion became approximately $1.9 billion in one day. But AGQ still had to rebalance. And here's the math that should make you uncomfortable. With over $10 billion in silver exposure going into the day and silver dropping 36%, AGQ was forced to shed billions of dollars worth of silver futures to bring its leverage back to 2 times. The estimate from analysts who tracked this in real time is approximately $3 billion in forced silver futures selling. $3 billion in a single rebalance window. And here's the part that really matters. When did that rebalance happen? During the midday trading session, the exact window when silver hit its absolute low. $71. That is not a coincidence. AGQ's forced selling accelerated the crash at the exact moment it was already falling fastest. The machine pushed silver to its lowest point of the day. Now think about what that means. $3 billion in mechanical, forced automatic selling hit the silver market in a concentrated window. Not because anyone decided silver was worth $71, not because supply and demand shifted, because a leveraged ETF had to rebalance, because that's what the structure requires. If you're finding this breakdown valuable, drop a comment below. Tell us where you're watching from. And tell us, did you know AGQ was doing this? Subscribe to GoFinance if you haven't already, because the second machine is in China, and it's even bigger. Now let's talk about the second machine, the one in Shenzhen, Jie-Worui, a gold and silver trading platform based in Shui, that's China's largest physical bullion trading hub. The place where real gold and silver changes hands in massive volumes every day. Jie-Worui attracted retail investors with a simple pitch, 0 fees, attractive buyback prices, and a product they called preset price trading. Here's how it worked. You wanted to buy gold or silver. You didn't need to put up the full price. You posted a deposit. As little as 1/40th of the spot price. 1/40th. That's 40 times leverage. So if gold was at $5,000 an ounce, you posted $125. And you got exposure to a full ounce. That sounds incredible. And for a while, it was. Gold and silver prices were surging. Everyone on this platform was making money on paper. The platform was growing fast. 150,000 investors. But here's the problem. Jie-Worui had no physical backing, no hedging, no reserves. They were not actually holding gold or silver to cover their obligations. They were running a leveraged betting operation disguised as a precious metals platform. This works as long as prices keep going up and nobody tries to withdraw. But the moment a large number of investors try to cash out at the same time, that's when the whole thing collapses. On January 20th, investors started trying to withdraw funds. The platform couldn't meet the redemption requests. Withdrawals froze. Within days, investors showed up in person at Jie-Worui's offices in Shenzhen. Videos posted on social media showed hundreds of people crowding the entrance. Some scuffled with police. They were holding contracts, phone screenshots, proof of what they were owed. The numbers are staggering. 10 billion yuan in unpaid funds. That's 1.4 billion US dollars. 150,000 investors. Most of them retail, working class people, housewives, people who put their savings into this platform because gold and silver were going up and it looked like easy money. The Chinese government formed a task force on January 31st. They announced Jie-Worui had begun processing repayments. They commissioned a third-party audit. They said the widely reported figure of 13.4 billion yuan was significantly exaggerated. But the repayment offers tell the real story. The platform proposed two options, either a lump sum at 20% of your principal or 40% paid out over 12 monthly installments. 20%, you put in $100,000, you get $20,000 back, and that's the generous option. In practice, actual payouts have fallen well below even that. One investor from Henan province put in $5,100. First redemption offer came back at $1,219. Second offer dropped to $244. Another victim had over $44,000 in her account. Cash, gold, and silver combined. She was offered $2,800, roughly 6% of what she put in. 6%. 150,000 people, 40 times leverage, no physical backing. And now the platform is offering victims pennies on the dollar while requiring them to sign criminal pardon agreements just to get that fraction. Now here's what connects this to silver hitting $71. Jie-Worui's collapse didn't just destroy 150,000 Chinese investors, it shook confidence across the entire Chinese precious metals ecosystem. When a platform this size collapses publicly, with police, with protests, with government task forces, it creates fear across the entire market. And fear in the Chinese precious metals market means reduced buying pressure. Reduced buying pressure from China means less support for global silver prices. At the exact same time, AGQ was dumping $3 billion in New York. Chinese retail confidence was collapsing in Shenzhen. Two machines, one mechanical, one psychological, both hitting simultaneously, both pushing silver lower. Now, about 75% of you watching aren't subscribed. If this is giving you the behind-the-scenes picture that nobody else is showing, hit subscribe. Drop a comment. Tell us where you're watching from. And tell us if you knew about Jie-Worui before this video. Because I promise you, most people in the West have never heard of it. Now let's talk about what China did next, and why it actually confirms the bull case. After Jie-Worui, China didn't just sit back and watch. On Friday, Chinese regulators suspended trading of 5 commodity funds. Full stop. Not a warning, not a fine, a suspension. The biggest one was the UBS SDIC Silver Futures Fund, China's only pure play silver fund. This fund had been trading at a 36% premium over Shanghai Futures Exchange silver contracts. 36% above where it should be trading. Pure speculative froth. This was the second full-day suspension for this fund since January 22nd. The first time they halted it, premiums stayed elevated, so they halted it again. Full day. No trading, no buying, no selling. 4 additional oil funds received 1-hour suspensions. The E-Fund Gold Theme Fund halted new subscriptions entirely. Chinese banks announced fresh measures to curb risks tied to retail gold accumulation products. The message from Chinese regulators was clear. We are shutting down the speculative mania. We are protecting retail investors from blowing up on leverage. We are doing this before it gets worse. Now, here's what most Western analysts are missing. They're reading these fund suspensions as bearish for silver. China cracking down on speculation means less buying pressure, means prices go down. That's the surface reading. And in the short term, it's partially true. Speculative demand from Chinese retail investors did contribute to the rally, and now that demand is being actively suppressed by regulators. But here's the deeper read, and this is where it gets interesting. The fund suspensions are targeting speculative paper positions. The 36% premium on the UBS SDIC fund was pure speculation. That premium was never backed by physical metal. It was backed by social media hype and FOMO. China is shutting down the paper speculation, not the physical demand. Look at what's happening in Shui, the physical market, at the same time. Despite Jie-Worui's collapse, despite the fund suspensions, despite everything, silver in Shui is still trading at a premium to exchange contracts. Physical silver is still in demand. The shortage hasn't gone away. The regulators are actually separating the two markets. killing the speculative paper frenzy, while the physical shortage underneath continues untouched. And that physical shortage is structural, not temporary, not speculative, structural. Silver charted its 5th consecutive year of structural market deficit in 2025. The shortfall in 2024 was 148.9 million ounces. That deficit is getting worse, not better. Solar panels need silver, electronics need silver, nuclear energy needs silver, battery technology needs silver. Industrial demand is not going away, it's accelerating. And here's the piece that almost nobody in the West is paying attention to. Samsung. Samsung C&T, that's Samsung's trading arm, one of the largest industrial conglomerates on the planet, did something very quiet last October. They signed a prepaid offtake agreement with Silverstorm Mining, $7 million up front to restart the La Paria silver mine in Durango, Mexico. The mine was idle since 2019. Samsung provided the financing to bring it back online. Drilling started mid-January 2026. Restart expected in the second quarter of this year. But here's the clause that made procurement managers across the industry gasp. Samsung locked up 100% of the mine's silver output for 2 years. Every ounce, for 2 full years. Gone from the open market. Samsung did not go to COMEX to buy silver. They did not trade paper. They went directly to a mine and locked up the physical output before it even existed. That is what smart money does when they believe silver prices are going structurally higher. They don't buy futures, they don't trade ETFs, they lock up mines, they secure physical supply before it's available, because they know, at the industrial level, that silver is about to become even harder to get. And Samsung is not the only one. This is a trend across tech and industrial companies. When corporations start locking up mine output directly, bypassing exchanges entirely, it tells you something the paper market hasn't figured out yet. The physical world and the paper world are separating, and the physical world always wins in the end. So here's where we are right now. Let me put this all together clearly. On Friday, 2 machines blew up at the same time. AGQ in New York dumped approximately $3 billion in forced silver futures, selling during its mechanical rebalance. Jie-Worui in Shenzhen trapped 150,000 investors and froze $1.4 billion. Together, they manufactured silver's drop to $71. Not because silver fundamentals changed, not because the world stopped needing silver, because 2 leveraged systems, one automated, one fraudulent, collapsed simultaneously and forced billions in selling. Silver bounced 17% from that low. Back to 83, that bounce is holding. But the question everyone is asking is the same question from Monday. Is this the bottom, or does it go lower before it recovers? Here's my read. And I want to be clear. Do your own research. This is not advice. This is my analysis based on the data. The AGQ selling is done. The rebalance happened. It's mechanical. It fires once per day. Friday's rebalance was the massive one because Friday was the massive move. AGQ's assets are now $1.9 billion. The forced selling pressure from that fund is dramatically reduced going forward. Jie-Worui is a one-time event. It's already collapsed. The damage is done. 150,000 people are already frozen out. That fear factor already hit the market. It can't hit again in the same way. The Chinese fund suspensions remove speculative froth, but they don't remove physical demand. And physical demand is what drives the long-term price. Now here's the thing that should keep you watching this space closely. February 27th, it's the first notice day for the March COMEX silver contract. First notice day is when holders of futures contracts who want physical delivery have to start declaring their intention. We already know COMEX is under pressure. Physical silver is scarce. Dealers can't source metal. Shanghai premiums are still elevated. Backwardation is confirmed. If significant physical delivery is demanded on the March contract and COMEX can't deliver, that's when the paper market loses all credibility. That's when the gap between paper prices and physical prices becomes impossible to ignore. Samsung already knows this is coming. That's why they locked up a mine. That's why they bypassed COMEX entirely. The structural deficit hasn't changed. 5 consecutive years of deficit. Industrial demand accelerating. New mine supply locked up by corporations. Recycling can't close the gap. New mines take 7 to 10 years from exploration to production. The high prices of 2026 won't translate into new supply until 2033 at the earliest. Silver, at 71 to 83 right now, is being priced by 2 machines that blew up. Not by the world deciding silver is worth $71. The physical market is telling a completely different story. Do your own due diligence. Understand the risks. Leverage trading in these conditions is extremely dangerous. Think for yourself. But if you're looking at the data, the structural deficit, the physical shortage, the corporate lockups, the February 27th deadline, and you're trying to understand why silver is at these levels right now, the answer is not fundamentals. The answer is AGQ and Jie-Worui. 2 machines that blew up at the same time, $3 billion of forced selling in New York, $1.4 billion of frozen chaos in China, and silver got dragged down with both of them. When the machines stop firing, or it's when the forced selling is done and the panic subsides, the physical market takes over, and the physical market has been screaming the whole time. Drop a comment below. Tell us where you're watching from. And tell us, do you think February 27th holds or breaks? That's the real date to watch. This is Mark from GoFinance. Stay sharp. Watch the data. Think for yourself. I'll see you in the next one.